Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at IREN.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
IREN is a really interesting story right now because they're trying to kind of master two very different worlds at the same time.
Exactly. It's this dual-track strategy that's got everyone's attention. They built this huge foundation as a low-cost Bitcoin miner.
A really big one.
But now they're pivoting and pivoting fast to become a major player in AI cloud services.
Which puts them right at the intersection of, the whole digital asset cycle and this just overwhelming demand for AI compute.
Oh, absolutely. And that market for AI infrastructure is just explosive. The compound annual growth rate, the CAGR, is forecast to be, what, almost 20%?
19.4%. I mean,
Yeah.
That is the exact kind of structural growth wave any company would want to ride.
And we're already starting to see that shift show up in their financials. It's not just a story anymore.
Okay, so let's dig into the numbers.
So for fiscal year 2025, revenue hit $501 million. That's a staggering 168% jump year over year.
Wow.
But here's the kicker. It seems to be accelerating. Their trailing 12-month revenue is already climbing towards almost $700 million.
So momentum is actually building, not slowing down.
Precisely. And the Q3 earnings release, that really drove the point home. Record results, revenue over $240 million.
And crucially, that's where the AI cloud services piece starts to appear on the top line, right?
It does. It's still a small slice, about $7.3 million, but it's there, it's real. The pivot is officially underway and generating cash.
And the market is definitely pricing in more of that.
Yeah.
Analysts seem incredibly bullish on 2026.
They are. The consensus forecast is for revenue growth to hit over 136%, with EPS growth around 84%.
Look, they're not just solid numbers, they're hyper growth numbers.
They are. But we do need to put a little asterisk on one of the big headline numbers from Q3.
The huge net income figure.
Yeah, the $384.6 million in net income. You really have to look under the hood on that one.
Because it wasn't all from operations?
Not even close. It included a massive $665 million unrealized gain on financial instruments.
Right, which is basically an accounting adjustment, not profit from mining Bitcoin or running AI workloads.
Exactly. The core operations are healthy, for sure, but investors need to understand that a lot of that reported profit was from their financial positioning.
It's a critical distinction. But what's really fascinating is how they're turning this potential into actual, tangible scale.
Well, the clearest proof of demand is the customer prepayments they've secured.
I saw that number. It's huge.
It's $1.9 billion. I mean, think about that. Customers are handing them almost $2 billion up front just to reserve capacity.
That's the ultimate vote of confidence, really.
It is. And that kind of scale all comes down to one thing: power. In this AI gold rush, access to power is the real bottleneck.
And they seem to have that piece of the puzzle figured out.
It looks like it. They've got access to contracts for 2,910 megawatts of grid power. And they're building out huge data centers, like the one at Childress, to use it.
That power access is a massive competitive moat. But the other big headline has to be the Microsoft partnership.
Oh, for sure. That's like the ultimate seal of approval. It gives their AI cloud strategy instant credibility and, a direct pipeline into really high-value enterprise work.
Okay, so to fuel all of this growth, you need cash. A lot of it. How's their capital position?
It's incredibly robust. They've got a deep war chest. The balance sheet showed over $500 million in cash.
And they've been raising more, haven't they? Aggressively.
Relentlessly. They secured about $1 billion through an at-the-market share sale, an ATM.
Where they just sell shares into the market over time.
Exactly. And on top of that, they just closed another $1 billion offering, this time 0.00% convertible senior notes.
0%. So that's essentially an interest-free loan of $1 billion.
It is, with the catch that the debt holders can convert it into company stock later if the price hits a certain target.
Wait, that is a staggering amount of capital to raise so quickly. But it brings up a big question, right?
Yeah.
Dilution.
That's the core trade-off, absolutely.
With the ATM sale and these convertible notes out there, how worried should investors be about their stake getting smaller?
It's a very real risk. They're raising from a position of strength, no doubt, but they're funding this aggressive expansion by expanding the share float. It's a classic growth now, worry about shareholder impact later strategy.
And just to put some numbers on the physical assets, they're still a huge miner.
Oh, yeah. They have about 50 exahash per second of self-mining capacity. That's an enormous amount of computing power.
But the number to watch for the future is the GPU count.
That's the one. Right now, it's around 1,900 NVIDIA GPUs. That number seems small, but its growth is the single best indicator of where their future high-margin revenue is going to come from.
Let's switch gears to the stock itself, because the technical momentum is just undeniable right now.
It's been on an absolute tear, up 153% over the last 3 months alone.
That's a powerful bullish trend.
For sure, and technically the chart looks really healthy. The stock is holding comfortably above both its 50-day and 200-day moving averages.
Which, for anyone watching momentum, is a classic sign of institutional money flowing in and strong upward pressure.
Exactly.
So for traders looking at this right now, where are the key levels? Where's the floor and the ceiling?
It looks like there's some pretty reliable support forming near the $45 mark. On the upside, you've got some early resistance setting up around $54.
And if it breaks through that?
Well, the near-term outlook suggests the trading range could stretch all the way up to $75. Consensus forecasts suggest a potential upside of over 54% from here. It's volatile, but a high-reward play.
Now, what about valuation? If you look at their trailing price-to-earnings ratio, it's around 23. That seems pretty reasonable given the growth.
It does. It looks manageable. But, and this is a huge but, you have to look at the forward PE.
This is where the hype comes in.
This is where you see the expectations. The forward PE, which prices in those massive 2026 growth forecasts, it just skyrockets to 242.87.
242. That is astronomical.
It tells you everything. The market is pricing in a flawless execution of that 136% revenue growth. There is no room for error. You have to ask yourself if the company really has 242 times its potential earnings baked in already.
It's a huge red flag for caution. So let's talk about the other risks. Despite the AI pivot, that legacy business is still a major factor.
It's their primary risk. Their revenue is still heavily tied to the very volatile price of Bitcoin.
So a crypto winter could still really hurt them.
It absolutely could. And we mentioned the need for capital. This business model just eats cash. The capex is relentless.
Always needing more money for new miners, new GPUs, new data centers.
It's a constant treadmill. Any slip up in execution or a tightening of the capital markets could create a lot of stress very quickly.
And we've already seen some of that pressure on the margins, haven't we?
We have. The commentary from Q1 of fiscal 2026 noted that cost of revenues was up, get this, 52.6% in a single quarter.
Wow, what drove that?
Almost entirely from spiking utility costs. Managing energy costs is the whole game in this business. They can have the power contracts, but if the rates go up, it can just crush their profitability.
And there's one more thing we can't ignore, the insider activity.
Right. Back in October of 2025, a director and the co-CEO sold 1 million shares.
1 million. At around 33 others a share.
Yeah. Now look, insiders sell for 1 million different reasons, but a sale of that size from the C-suite is a data point you have to register, especially with the stock trading so much higher now.
Okay, so looking forward, the next 3 months are just packed with catalysts. This is where the story gets tested.
It's a make or break period. These are the dates that will likely decide if the stock pushes towards that $75 target or pulls back to the $45 support.
So what are the key dates for the calendar?
First up, December 10th, 2025. That's the Q4 preliminary operations update. Analysts will be tearing that apart.
And they're not just looking for GPU counts, right?
No, they're looking for proof of margin resilience. Can they manage those high utility costs we just talked about? That's the first big test.
And then we get into the new year.
Yep. February 7, 2026 is the big one. The Q3 fiscal 26 earnings release. That'll give us the clearest picture yet of how the AI transition is really going.
But there's something to watch even before that.
Right. Around February 1st, we'll see the institutional 13F filings.
Which shows who owns the stock.
Exactly. After those huge capital raises, we'll get to see if the big institutional smart money players were buying up those new shares or if they are getting out.
And beyond the filings, there are physical milestones to watch for.
For sure. We're waiting for them to flip the switch on the Sweetwater 1 substations and also to see the continued delivery of new GPUs. Both are expected in Q1 26 and are fundamental triggers for future growth.
Okay, let's talk about the more speculative stuff. The rumors, the market chatter.
Well, the biggest rumor out there is about another strategic partnership, someone besides Microsoft.
Another hyperscale cloud provider.
Or a major AI infrastructure firm. If they landed another giant partner, the stock could re-rate instantly. The demand for this kind of infrastructure is just that intense.
I've also heard some chatter connecting them to the whole ESG narrative.
That's right. The idea is that as U.S. Bitcoin ETFs grow, there could be specific demand for clean Bitcoin, mined with sustainable energy.
And IREN could position their product as a preferred low-carbon ESG asset.
Exactly. It could create a whole new niche market for their mining output.
And the final rumor is just about pure expansion.
Yeah, that they're negotiating for major data center lease expansions across the U.S. to handle all the enterprise AI demand they're seeing. If any of that gets confirmed, it's another massive accelerator.
So let's tie this all together. IREN is heading into 2026 in a really strong, but also very high stakes position.
I think that's the perfect way to put it. They have record revenue, a ton of liquidity from those capital raises, and a growth story that hits two of the hottest sectors out there: digital assets and AI cloud services.
So for you, the listener, there are really two ways to look at this.
Yeah, on one hand, it's a very compelling short-term trade. You have all these catalysts and earnings dates coming up in the next quarter that are bound to create volatility and opportunity.
But there's a long-term story here, too.
Absolutely. This is a chance to get exposure to the multi-year structural growth in AI compute. Their position as both a power-optimized miner and a cloud provider gives them a really unique edge, but only if they execute perfectly.
The challenge for IRN now is translating that impressive growth forecast and huge capital liquidity into maintained margin resilience. They must prove that they can continue to shoulder these heavy utility and expansion costs without sacrificing the profitability the market is so aggressively pricing in today. That is the execution risk priced into that 242 forward PE.